Okay, this is the code, so you can copy the code. If there is any problem with the code, then you can come back to me. And so during the break or even after class, let's say better during the break. If you can do this, is better. So that if there is a problem, I can manually check you in. So, just to know, last week there was Douglas. What did you study with Douglas? You studied intermediaries of UK? Is what you studied? No. IOSCO principle, then authorization in general or authorization of the UK system. Okay, so basically, I mean, you studied intermediaries in general, but then that generic in general, in reality, was related to the international financial architecture. So I think he spoke about IOSCO, and then everything that he said can relate also to the UK as a system, legal system that is domestic system. So there it is a bit different in the sense that there are specific rules. Those rules, if he didn't say to you, actually, you need to look back. This is something that you can find also online. The Financial Conduct Authority that has an handbook, and then there is the Prudential Regulation Authority that has a rule book. So the rule book of the Prudential Regulation Authority, the handbook of the Financial Conduct Authority. And there you find, for example, everything related to authorization requirements, but many things that actually the UK did in the past, they are related to the European Union, because it was a member state of the European Union. So in reality, for example, for mutual funds, in Europe there was the Alternative Investment Directive. So that is something that then was translated into national legislation. So the same requirements that applied in Europe then applied also in the UK. Then with Brexit the situation changed, although they tried to respect a sort of alignment. So still today, although there is Brexit, especially in financial services, especially in capital markets, the two spheres are equiparated. So in reality, they didn't make still today a lot of changes. Even the new regulation, that is the UK reform in crypto assets and digital assets, is framed on the EU regulation, the regulation on digital assets and crypto assets. So that regulation that is applicable only for European member states, it is now today in the UK in a different law, that is the Financial Services and Markets Act 2023, but actually there is also a regulation of the UK that is 2025, that is new for crypto assets, and that is designed on the basis of the regulation in the EU. So in reality they are similar, although the perspective is different. This perspective, then I think Douglas, he has a specific lecture on digital assets, so he will tell you more about it. But generally saying, the approach is different in digital assets between the UK and then EU. So, for example, the conception of property of digital assets in the EU, it is fragmented. So this is something that is also applicable to what we study today, that is the European Securities Regulation. So we are 27 member states in Europe, and each member state can have a different conception of property. So then to define what is a digital asset and whether a digital asset is property and whether I can enforce my rights based on property law, it depends on the national system. So we have in digital asset, and we will see also in securities regulation today, a system of laws that is different in every jurisdiction, especially in terms of enforcement. So once I need to enforce my rights in one national state, I might have a different outcome. So although maybe this is the big lecture, a big lesson of today, although in the European Union, as an international organization, in reality I can have harmonization of the law, then the enforcement rights are different and they are variegated. This is why in reality this kind of convergence is very difficult, because there is not centralization. Where was centralization in securities law? We saw together. Which is the state in the world that is centralized? The US, exactly. The US is centralized because we studied together that essentially there is the Securities and Exchange Act 1933 and the 1934 and the Securities Act 1933. So those two acts are fundamental acts of the securities laws in the US, and there is a centralization of the system because there is one single financial regulator, securities regulator, that is the Securities and Exchange Commission. So the Securities and Exchange Commission has powers in terms of enforcement, has also the power to enact new rules within that financial system at federal level. So one main point that is very important to keep in mind is that the United States of America, they are a federation. So being a federation, what is the main important point of a federation? Why? How you can define yourself to be a federation? For example, the European Union is not a federation. It is an international organization. Why this difference? Why the United States of America, they are a federation and Europe, no? European Union. Yeah, you can do both, yes.
Because in the case of the United States, it's one government, while in Europe it's several governments under and have one institution governing like the general principles. But in the U.S. and in Mexico, for example, it's one government and different states which are governed by the same government. But
Yes, I mean, this is something that, I mean, we can even see in Spain, in Italy, that essentially there is one central government, that is the Italian government, the Spanish government, and then the country is divided in different regions. Each region has autonomy, and so they have their own parliaments, let's say, but these parliaments are at local level. They are like in administrative law parliaments, that they are only holding meetings in order to solve central questions of that region, but then of course they don't have sovereign powers. So for example, in terms of defense, in terms of health and security, those are priorities of the national state as a sovereign state. So this is something that, I mean, is common in all the world. So the state then can be divided in regions, different regions, or can be divided as a federation. For example, Germany is a federation as a state. So as a sovereign state, Germany is federation. But Europe is not a federation. So the main difference between a federation like the United States of America and the European Union, that is the international organization, lies in the fact that, for example, in Europe today, and I think this is something that you have seen also in the Financial Times, we don't have a national army. So there is not the EU army, for example. Now we speak in Europe in order to spend more and to try to have a defend fund through which we can set up this army. But today does not exist. Yes.
Question on the banking sector in the European Union. Can we talk about federalization of the banking sector in
Yeah,
the
in fact
European
now we will go into this because we need to compare a bit banking to securities, that they are different. But that is a good question and is good remark. In the end, there are different systems of laws. And then this kind of centralization that we can see in banking at the European level does not exist in securities in the European Union. But before this, I wanted to bring back all the discussion about why the European Union is an international organization, how it differs from the US, what is the characteristic that I mean is the feature, the main feature why you are an international organization and why you are a federation. One distinction we said is the army. So we don't have this common defense. Does not exist in Europe, but exists in the US because there was an American Revolution. And so the first thing that they set up was the army, American army. So this is one central point to become a federation. If you don't have one single army that is under the federal government, in reality you cannot define yourself as a federation. So this is why Europe today is an international organization and the United States of America, it is a federation. It is one common feature, I mean one feature of distinction. What is the second? Another thing, cultural thing that you can see that is different between European Union and United States of America. That you can think, for example, in Europe we are 27 member states, but in all these 27 member states we all speak different languages. So this is a common barrier, I mean it's a cultural barrier. We have different cultures also. Sometimes when the UK was part of the of Europe, of the European Union, in reality in the 70s they joined the European Union, but still they spoke English, they have different traditions, but they have also a different legal tradition that is common law, while all the other states of the European Union, they are civil law countries. So already you can see the contrast. So Europe tried to put together different states that are different also from a cultural point of view, from language point of view. They don't have a common identification. If you look at the US, there is a common identification because in reality they all speak English and they define themselves as Americans. So everything was different and everything is different. So for this reason, the United States of America, they are a federation. And then as a federation also they had one single central bank that is the Federal Reserve. And then the Federal Reserve has the power, the privilege to issue currency, and so the dollar in reality then become the common currency for all the other states. Before the Federal Reserve, everyone could have its own currency. The currency reality in each state of the United States of America was issued by commercial banks, and everyone had different kind of dollars that still today, I mean, from an historical point of view, you can have a look in museums. So they are no more in use, but actually before the green dollar, there were different kind of dollars with different kind of power of expenditure. So in reality, the value of the dollar of Louisiana was not the same of the value of the dollar of another state. And that was a problem for the country. For this reason, then they decided to centralize the power within the Federal Reserve, although it took a little bit of time. The same thing it is in Europe. In fact, I mean, if we speak, for example, about, here is more about the European system of financial supervision, but within this system, in reality, if we think about supervision, banking supervision in the European Union, it is in the hands of the European Central Bank. So we have the European Central Bank that is at the center, but actually then each member state has its own central bank. So it is not the same of the United States of America. Although something that can be equiparated is the fact that the European Central Bank is issuing the euro, and so in reality has this power, privilege to print money, and so only through the European Central Bank this is done. But then in order, for example, to supervise the banking system, they created a system that is based on a single rule book, something that you will see in securities regulation, something that you will see in banking regulation. So in reality, we have one single book where all the rules are harmonized, uniform. This is more a desire of Europe to promote uniformity. but in reality then you cannot have this kind of uniformity. You can have centralization in the case of banking, because actually since the global financial crisis, that is 2007, 2008, they created a single supervisory mechanism. So in reality it means that today, if there is a bank,
Are you the one that just came in? When I called you, why didn't you answer?
Sorry, I didn't hear you.
well,
Please come.
okay.
Sorry.
No, it's fine. It's fine. So basically, I mean, single supervisory mechanism, it means that if we have the European Central Bank at the apex, the European Central Bank in reality is supervising in direct manner all significant banks. So if there is a significant bank at European level in one member state, 27 member state, usually there is. Because for example, if we think about Italy, it's Unicredit. If we think about other states, there are other banks that might be significant. How they can be significant? They are significant actually. This is something, is a list that the European Central Bank every 6 months is going to draft again, that is monitoring and looking the threshold of profit turnover of those banks and the operation that should be cross-border. If there is cross-border operation, if they are international banks, if they have branches and subsidiaries around Europe and the world, they can match this threshold of significance, so they become significant banks, and they might, of course, if they fall, if there is a collapse of the bank, they might then generate systemic risk. So in order to avoid systemic risk, they invented this single supervisory mechanism through which the European Central Bank is at the top and has direct supervision of significant banks. Then, if a bank that is significant is going to collapse, the European Central Bank can activate, in reality through a procedure that is quite complex, all mechanisms that they relate to the resolution mechanism. So there is a banking resolution directive, and that directive, that is the resolution and recovery directive, is deputed in reality to make possible the resolution framework. But this resolution framework is activated firstly by the European Central Bank. So, to answer your question, yes, in European Union, in the banking system, there is more centralization, for sure. And so there is a single supervisory mechanism, then a single resolution mechanism, and then there is a third pillar that is the European Deposit Insurance Scheme. The European Deposit Insurance Scheme still today has never been adopted. So we have one pillar that is not adopted yet. Why, in your view? What is the reason why it was never adopted, the European Deposit Insurance Scheme? Political, yes. There is a problem of politics. So in reality, at the end of the day, there are some of those countries in Europe that are G7 countries like France, Italy, Germany. Those countries, they have a banking system that is more resilient. But then there are smaller countries like Estonia, like Lithuania and others. Actually, they might face a crisis, and actually, if there is a crisis, then as we know, depositors, they might wish to withdraw money, and they want to be insured for at least 100,000 euros. And this amount of insurance usually is provided by national competent authorities. But it's also true that in reality, because we are in Europe, within the European Banking Union, in fact, today we need to speak about the Capital Markets Union, but in banking there is the European Banking Union. So within the European Banking Union, the idea is that if this third pillar is activated, each member state will contribute a part of money within a single resolution fund, and then this money are used in order to save the banking system of the country that is going in reality in bad situation, territory. This is something that in reality has never been done due to politics. The same thing is at the point of the European Central Bank that, for example, if we think about a normal central bank, a traditional central bank like the Federal Reserve, in reality they have uniform powers that are directed to all the states. This cannot be done through the European Central Bank. So, for example, if we think about unification of taxes, each member state can impose its own taxes. And so for monetary policies, the monetary policies, they cannot be conducted in uniform way as in the United States of America. This is a problem of Europe. So in reality, Europe or the powers of the European Central Banks are not equivalent to the Federal Reserve because it's not a federation. So there is not fiscal union, essentially. And so for monetary policies, this is a problem. But a problem where in the course of the years, they tried to solve the situation, but still politics matters. So in reality, they never agreed politically how to solve this issue or how to change the situation. Because, for example, if we think about the Bank of England here in the UK, in reality, the Bank of England has to answer to the Treasury. The Treasury also, in line with the governor, is also instructing the Bank of England to change maybe their policies if there is the need, for example, for a secondary mandate in order to boost employment, for example. This is not possible in Europe. We don't have a European Treasury. European Treasury does not exist. So, although there is a sort of more centralization in terms of the banking union, there is not equivalence between the banking union, the European Central Bank, and the Bank of England, for example, as a national central bank. Make sense? Any question on this? No? So, that essentially, I mean, we already discovered one point, that in banking is very different from securities. And this is also because in the global financial crisis, the main sector that was affected was the banking sector. So many reforms that we see, they all relate to banks and the banking industry. But then there were also reforms in securities laws that they are not less important. In fact, then there are different agencies in Europe, as you can see here, the EBA, the European Banking Union, the EIOPA, the European Insurance Occupational Pension Authority, and then the European Securities and Markets Authority. So they respectively represent securities, the ESMA, EBA, the banking, and then insurance is the EIOPA. So the three sectors, main sectors of financial markets at international level within the European Union are regulated by those agencies. But they are agencies. So in reality, what is the main problem of an agency? They have?
They're not elected, so they don't have the democratic.
Exactly. There is a democratic deficit. So we can elect members of the Parliament, European Parliament, but we cannot elect members of the European Commission, that is the equivalent of a government in the European Union, because the European Commission also is going to introduce a bill to the Parliament, European Parliament. So it's playing the equivalent role of the government at national level. The members of European Commission are not elected, the members of EBA, EIOPA, ESMA are not elected. You need to apply. Every one of us can apply. If you are a professor, even your years of PhD, your publications are worth it in order they give you a score, and this score then is helping you to pass the exam, but then you pass an exam and you can be an official of ESMA. So in reality, you are not elected. In fact, the main problem in Europe is technocracy, because all the people, they think, if we didn't elect those people, why we need to follow what they say? Because in reality, democracy is based on member of parliaments that are elected by the population, and then they pass a law, and the law is the expression of what the population wanted in reality indirectly. This is democracy as a principle. Here there is a democratic deficit, they say many times in Europe, because all these kind of agencies or all these kind of institutions like the European Commission are composed by members, non-elected members. And so technography is important because they need to solve issues that are very technical in banking, the European Banking Authority, in insurance, EIOPA, in securities markets, ESMA. Those are technical issues. So they think if we have a model based on agency, European agencies, we are better equipped in order to answer to all the market risk that they can happen during that moment. But that is what is in reality creating then a democratic deficit. There is not a solution to this. So in reality still today we follow this system that they are non-elected, and we try in reality to make the system more democratic through something that we will see today specifically in securities laws, that is to follow the Meroni doctrine, but it is something that is not only for securities, can also be applied to any other agency within the European Union. So there are certain parameters of delegation of powers. So some powers can be delegated by the European Commission to those agencies, but in a manner that in reality should be quite restricted, cannot be very ample in order to give wide, in order to give discretion. Too much discretion in reality is too much concentration of power, and so in reality this can only give rise to this critique of democratic deficit. Is all clear until here? Then coming back to the start, because many of you, you are not from the European Union. We said that this is not a federation, it's not the United States of Europe. We will become maybe the United States of Europe once we have, first of all, an army, a common defense, and one European army. That doesn't exist today. But there are debates you can follow on Financial Times on this, for example. Then, in addition to this, we need to say that there are different cultural barriers among the member states. We don't speak one single language like English in the US, but we speak many different idioms. This has been culturally something that can undermine the European identification. How I can feel European if we all speak different languages, we all have, I don't know, different cultures and traditions. But then Europe in reality answered this question, why we need the European Union. At the start we needed European Union in reality, for example, for common market, to establish a common market. Then we needed the European Union to face terrorism, for example. Then we needed the European Union today to have a common defense, because there is a possible war. That can be the Third World War, for example. So each problem has been used by European Union in order to justify the existence of the European Union. So this is something that you can read also in some papers if you're interested. This is not a course about European Union, but I was teaching European Union for many years in this country, and that were readings. For example, Domenico Maglione, if you read books, papers that he wrote, within the European Union he wrote different things about this kind of idea, why we need Europe and why Europe exists if we are all so different in some way. But still today, yes, we are not a federation. Any question? Then, why I define the European Union so as an international organization? Because as every international organization is based on different acts. So these acts, for example, if we think about the UN is international organization. But what is the main difference between the UN as an international organization and the European Union as an international organization, in your view, if you know? Because they are both international organizations, but still Europe is a unique example. Why?
EU law is superior over the national laws and the constitutional law. The UN doesn't have laws.
But UN has, for example, the UN resolution. If there is a conflict, there is a sort of law that they call resolution.
Yeah, but nationals can ignore it.
Sorry?
Nationals can ignore it.
Yeah, you can ignore it.
And the EU law is even higher than the constitutional law.
And
Yeah, I'm just saying that UN law is a soft law and EU law is binding.
okay, soft law.
In the European Union, differently from the IMF, there are all the three powers: legislative, executive, and judiciary.
Yes, essentially, I mean, the one point is the constitutional point. So European Union has more a sort of constitutional powers and constitutional structure, where we can see European Commission is the executive, then legislative the European Parliament, and then judiciary the European Court of Justice. But they are quite different from a national point of view. So one of the main difference here between, I don't know, something that we call international organization, that is the UN, and is passing a resolution. He said something, Lev, that is interesting, that in reality, if there is a resolution as a country, or you implement the resolution once it's passed at UN level, and maybe you are a member country of the UN, or otherwise there is no effect of that resolution. So the effect of those resolutions of an international organization, they depend on the member states of that international organization. In Europe is different. In reality, the main example of difference is the structure of their secondary legislation. So in Europe we have primary legislation that are treaties, so international treaties. They are normal international treaties, but they are the founding treaties of the European Union as an international organization. And this is the Treaty of Lisbon, and then the Treaty of Rome. Those are the constitutional background of the European Union, because one is telling you how the European Union can work, and the other, all other aspects that are related to fundamental rights of the European Union. Then we have also the European Charter on Human Rights, for example, that all together they form the similar framework of a constitution at national level, because in a constitution at national level we do have one single document where we find how the parliament works, how the government works. Then we find in the first article fundamental rights. These fundamental rights in the European Union is the EU Charter of Fundamental Rights, for example. But the EU Charter of Fundamental Rights was managed in reality by the Court of Strasbourg. That is the Court of Human Rights. This Court of Human Rights was independent at the start from the European Union as an international organization, but then the Treaty of Lisbon said that the European Union is part of this treaty, and so in this way there was no more controversy. So now today the constitutional framework is in this primary legislation of international treaties. So you can join the European Union, you can leave the European Union as any other international organization. If you join, you need to show that you respect democratic principles, values, and then if you want, you can also join the European Monetary Union, but it is something different because that relates to euro. So there you need to show that the country is ready to adopt the euro, is ready to make that move, something different. Coming back to us, the secondary legislation of the European Union is composed of regulation, directives, and opinions. So those are binding acts, and they are enforceable, but they have one feature, and the main feature why the European Union is very peculiar international organization is because of regulation. So regulation, they are directly applicable to all the member states. What does it mean? That is the only thing, while a resolution of the UN is not directly applicable because you need a national act to implement the resolution. In the case of the European Union, the regulation is directly applicable, so it means that you don't need the national act. So the regulation, as you can see, is giving you already uniformity of the law. If there is something passed by the Council, the European Parliament, that is the regulation, this secondary legislation is directly applicable to member states. For example, the prospectus regulation in securities law that today we have in the form of a regulation, before was a directive, then became a regulation. Became a regulation because we wanted the Capital Markets Union, through the aid of ESMA, European Securities and Markets Authority, they wanted to implement a regulation. So to implement something that can give harmonization, minimum standards to all the member states, so that in reality the final outcome that we can see does not differ in each member state. Why it is important harmonization of the law?
Avoid regulatory arbitrage.
Yes, to avoid regulatory arbitrage. So if there is no harmonization of the law, we might have regulatory arbitrage because everyone issue its own rules, and so one issuer of securities, for example, that wants to carry out an IPO will look at all the member states and will say, I will carry out this in Amsterdam because maybe the requirements of prospectus are less burdensome in comparison to Austria. And so they can do forum shopping. So to avoid forum shopping, to avoid regulatory arbitrage, that is very different from financial arbitrage, two different things. This is the regulatory arbitrage. To avoid regulatory arbitrage, they issued regulation. So that in this way we follow the same rules. And so if there is a prospectus regulation that is applicable in all the member states, and so it means that if I am an issuer and I do this IPO in Italy, or I do the IPO in France, or I do the IPO in Slovakia, wherever it is within the European Union, I will follow the rules of the prospectus regulation. So are the same for everyone. For example, within the prospectus, and this is something that we said in the past, I need risk factors. And so every prospectus will have risk factors. In the prospectus, I need to have the information of the issuer. I need to have at least 3 years of certified balance sheet. All this information must be there. If they are not there, you are not in compliance of the European Union law. And so that is a problem. But of course, one point, once you have a rule, is not enough. So you might have a rule, but then you need implementation of the rule through enforcement and through interpretation. Because still, at national level, many judges or judiciary organs, they might interpret the prospectus regulation in a different manner from the authentic interpretation of the European Union. So European Union has created a system through the European Court of Justice to avoid these two.
And I think it's interesting for this that you adopt secondary or primary EU laws in each law, that there are two differences between a monistic and dualistic system. Right?
Yes,
That's a very important distinction.
yeah, monistic and dualistic. That is something that relates to some countries. In reality, depends on the constitution, essentially, on their constitution. In some countries, the constitution is saying that actually they are monistic state. It means that whatever is coming from the EU, they are directly in parallel implementing that, while others, they need always a national act. But for the regulation, let's say this is not a big problem because it does not apply, because our principle is the direct applicability within European Union law. But the problem is within then directives, because directives are always part of the secondary legislation of the European Union, but directives, they don't have direct applicability. So in reality it means that there are some countries, all the countries of Europe, that they must implement the directive through a national act. So if there is a directive on payment systems in the European Union, you will have then a national act in Italy, in France, in Germany, that is translating the language of the directive at international level to a domestic level. If there is not a national act, there is not implementation. Yes?
No, that's what I was trying to say, that most of the times it's the same text, just
Yes,
translated,
exactly.
the EU countries.
Yes, usually it's the same text. You need to translate the international language into national language. And there is this system of dualistic, monistic, but generally I think those are things more related to European Union law as a course. So you don't need to know for real. This is just to give you an idea how it works. So the primary acts that are constitutional acts, then secondary legislation, the regulation directly applicable, the directive that is not never directly applicable, you need a national act. Then within directives, the directives are addressed to member states, not to individuals. And this directive in reality has a time of implementation. It's not telling you you need to implement today the directive. You have a minimum number of years, 5 years, to implement. So I don't know, Italy can be very good and maybe is going to implement the directive in year number 2, others in year number 4, others in year number 5 until the end. So in reality you can wait. But still there, what is the difference between a directive and regulation? That the regulation is directly applicable. So in reality you cannot make a law that is going to provide less rights from what is written in the regulation. In the directive also is the same principle. You cannot go below this minimum threshold harmonization condition, but you can go also above. So for example, in payment systems, if there are, every time that I pay with a debit card, there are fees that are collected by MasterCard and Visa. So these payment system platforms, in reality, since the time of the multilateral interchange fees regulation and the payment system directive, they had their own fees capped at a certain percentage. So now all member states of Europe, they must respect this percentage in order to give more protection to consumers. If you want to give even more protection than this, and so the cap is even higher, you can do. But that is on discretion of member states. So the member states in directives, they still have discretion, but discretion only to give more protection, not less protection than what is agreed at the international level. Make sense? And then there are opinions. The opinions, in reality, they might be issued by the European Commission in competition law, for example. They might be addressed to member states, they might be addressed to businesses, especially because in competition law there are anti-competitive effects, and they might tell you with that opinion what you need to do in order to carry out the merger. You need maybe to reform your business transaction. That is the idea. All these three, they are all binding, and they are an example of hard law. So, primary legislation, binding hard law. Secondary legislation, binding hard law. And then there is recommendations. A recommendation is soft law. So the recommendation is within this framework of secondary legislation, but it is the only one that in reality is not truly binding. So that is something that is more related to soft law. It is an advice that is given because it's a recommendation, and the individual or business can comply with it or not. Usually you comply with it because it's coming from an institutional background that is coming from the European Commission, for example. So unless you don't have a good motive not to adhere with the recommendation, you will try to adhere with the recommendation. That is the principle, because it's the same principle of the international financial architecture, where there is a where there is a IOSCO, where there is the Financial Stability Board, the Basel Committee on Banking Supervision. So as you can see, this kind of framework, banking, insurance, and securities, it is replicated also at the international level by the international financial architecture. So we can say that here there is the international financial architecture that is at the top of everything, and it is based on standard setters. The standard setters, they are giving you recommendations, guidelines, but everything is soft law, so nothing is binding coming from there. The capital requirements, liquidity requirements issued by the Basel Committee on Banking Supervision, they are soft law, example of soft law. You can, as a bank, not adhere with that, but then you have a problem in cross-border operations once you operate with other banks, especially from Europe, from the West, where in reality they all adhere with that capital requirements, liquidity requirements, or coordinated supervision principles, or digital assets requirements that are always issued in the banking sector by the Basel Committee on Banking Supervision. So in reality, although that is a standard, a soft law example, still it is harder than hard law, we say, in finance, because everyone will not dare in reality to put in question this. In reality, a person that put in question this system of the international financial architecture is Trump, because in his view, even there, the main problem is democratic deficit, technocracy, and so in reality he was elected by the American people to legislate for the American people. This has to be through the Congress, not through the, in reality, adhere to standards that are designed by technocrats. So that is why Trump is against the IMF, that is part of the international financial architecture, is against the World Bank, that is part of the international financial architecture, is against more capital requirements for banks and big banks that are designed as capital requirements, the Basel III, for example, is against because in reality he wants to protect the American banking system. And so the more capital requirements you have, the less margin you have to make business as a bank. And that is why in reality this is against its own politics. So politics today matters. We saw also in the last lecture before Douglas, in reality, that there was a Washington consensus that was starting from Washington as a policy in securities laws, then was passing through London and then from London to Brussels. But today, in reality, this is something that does not exist anymore because there is more unilateralism. This is something that we saw in that lecture. So all these things that we discuss here are good for the essay. So if there is an essay, this is critical thinking. You need to assess in the world that we live today how all this system that we teach to you can work together. So international financial architecture is part of international law, international public law, and it is at the top. Now that we look at Europe, in reality it is an international organization, so the EU is just below. That is an international organization, but still is part of the international law. So if you were in other times, still today in this country, because this country now did Brexit. So with Brexit, European Union law is no more a compulsory subject, but became something that is more related to international law. So if you study international law, you study also European Union law. This was even the past before they joined the European Union in this country. And now they came back to the old past. But essentially that is how it works, because it is here, in reality it is part of international law. Within this international organization, we said it's very different from the UN because of regulation, because of the structure, how it is structured. It's a unique example. And then within the European Union, we have here probably another level that is the domestic level. Domestic level that is composed, in the case of the European Union, of all the member states. So all the member states, they need to pass, in case of directives, their own national act. For example, if there is a bank recovery and resolution directive, that was adopted how? The bank recovery and resolution directive, it is a directive issued at international level, that is the European Union level, but actually was adopted as an example of hard law based on a recommendation of the Financial Stability Board, that is here. So the Financial Stability Board, following the global financial crisis, they said you need, in that document that is called the key attributes, they said you need banking standards, you need a resolution regime. The resolution authority has these powers. The resolution regime is composed by bail-in and then bridge bank and all the other tools, different crisis management mechanism that they are an official response to crisis. But still, because it's here, it is just soft law. It is not directly applicable, and you need a national act. In the case of the European Union, we are in international law. This national act does not exist, but we have the equivalent in international terms that will be then addressed to all the member states, and is the Bank Recovery and Resolution Directive. Within the Bank Recovery and Resolution Directive, you have in reality the resolution tools. And then, from this moment, you need to arrive to the domestic level. So all the member states of the European Union, they need to pass their own laws in order to copy and paste what is in the directive and to give in reality an implementation that is effective at national level. So today all the member states, they adopted the Bank Recovery and Resolution Directive. Today all the member states of Europe, they have their own system of resolution for banks that are likely to fail or failing or likely to fail banks. But this is possible through this kind of system. So the starting point is always the international financial architecture, for example. Because even, for example, for IOSCO might dictate here some standards, recommendations for special purpose acquisition companies or for prospectus requirements. Then the EU is going to adopt a directive or a regulation. At the start, in the case of the prospectus, was a directive, then became a regulation. So the regulation even better because it's directly applicable. And so it means that then all the national all the national member states, they adopted that rule for prospectus requirements, for example. But still the process started from this point, that is the international level, that can even be the supranational level, or can be something that is more international than international. So where some people, they say they govern the world. They govern the world in this level, because here is where, although it's a standard, then it's adopted in all the world. And in the case of Europe, we'll go through secondary legislation, directives and regulation. All clear? So if you have this kind of idea, now you know how to read the slides. In reality, these slides are based on things that, are only related to securities regulation, because this course is about securities regulation. But because you are not aware, not every one of you is from Europe, you will see it's like a sort of handouts. So you can use the slides, you can cite the slides within your essay, it's not a problem. There is not a standard format, so for example, OSCOLA does not tell you how to cite a slide, but you can cite as you want, as you wish. You can say Dalvia, slide week number 5, and so on. So this is something that you can take from the slides, you can even copy and paste and quote, but you cannot do without quoting, because then otherwise it's plagiarism, only that. So this is important then to keep in mind, because we say always in every year, in reality we need to avoid plagiarism, because then what happens is that we might receive a high level of plagiarism, like every time that you upload your essay on Turnitin, that is detected for plagiarism. If then the level is very high, the percentage is very high, that is a problem, because then we have to report you to the administrative office. Any kind of penalty, any decision is taken not from us, but from administrative office. So we just mark the content, and we just give you the actual mark. That mark can be penalized. So sometimes can happen that here we are many, some of you receive your marks, others still is pending. Is pending because might be under plagiarism check. The check is conducted by people in the third floor. So usually it's quite long. So in reality you need to wait quite a bit. And the same thing, I don't know, maybe it happened to you in recent exams, maybe. So coming back to us in the architecture of European securities regulation. Now, the EU, we said already, does not possess, and this is something that exists for securities regulation, the equivalent of a code or unified securities code comparable to the US, because the US, we said they have two fundamental acts, the Securities Act and the Securities and Exchange Act. Those were adopted in 1929 in the crash of Wall Street, 1933 the first, 1934 the second, and actually still today they are the backbone of the US securities regulation. In Europe we don't have this. So in Europe we have a system of secondary legislation between directives and regulation. We prefer regulation if we want more harmonization of the law, directives also are giving this idea of unity of the law, unification of the law, but still dependent of member states. Then also to finalize what I said before, if there is a member state that maybe does not implement within the time frame of the directive, there is an infringement procedure that is conducted by the European Commission. So the European Commission at the start will not penalize the country, so will just issue a sort of advert saying you must implement the directive, but then the country may be still in delay. At that point in time, usually there is a pecuniary sanction of millions that the state has to pay to the European Union as a form of penalty, essentially. All clear? Then this European system of financial supervision was created after the global financial crisis. So after the global financial crisis that started in the US with the collapse of Lehman Brothers, we already, I think, examined the Lehman Brothers collapse. We did together, no? In class. A bit about the subprime mortgage lending crisis. So in reality, at that moment in time, there were many reforms. The main reforms were conducted at the international financial architecture point. So there is the Financial Stability Board. They issued the key attributes as the recommendation for banks. And then I already explained to you the system in banking. Then from the European point of view, the answer was to establish and create this European system of financial supervision. And then on the side, to also have the European Systemic Risk Board. So from that point of time, they started to understand that two things are important: micro-prudential supervision and macro-prudential supervision. Some of you took regulation of financial markets, so you should know what is the difference between micro and macro prudential supervision.
One sees the oversight of the whole forest, while the other supervises each tree. So
Yeah, very good.
translated, one considers the macro aspects of the financial environment, while the other one looks at the specific institutions and their well-being.
Yes, essentially, Professor Lastra came with this example that essentially, if I need to supervise the single tree, imagine a forest that there are many trees. If I need to supervise only the single entity, so the single tree, that will be micro-prudential supervision, while if I need to supervise all the forest, and so that the fire that is coming from one tree will not spread to all the forest and then the forest is destroyed, that is macro-prudential supervision. So macro-prudential supervision will look more at systemic risk. And for this reason, to monitor systemic risk, we have today the European Systemic Risk Board. And then the European System of Financial Supervision, that is composed by this micro-prudential supervision. So we supervise the single entities, and there are specific European agencies for different sectors. We said already the EBA for banking aspects, EIOPA insurance, and then ESBA securities. And then below that system of international law, because it's an international organization, the EU, we have the national competent authorities. So still today there are, for example, in Italy, CONSOB. CONSOB is the equivalent of the Financial Conduct Authority here. Or there are others equivalent competent authority at national level in every member state. They are always carrying out supervision function, but still, in the case, for example, of banking, it depends, because in the case of banking we have a banking union. So within the banking union we said that is the European Central Bank that will supervise directly in each member state the most significant banks, those that they can have this kind of aspect of systemic risk, essentially. Of systemic risk also, in your essay, you might say that does not exist a definition of systemic risk. So there is not a definition. There are some people that they said it's like pollution. We need to avoid pollution, but even there, in reality, we don't know how, or we don't know how pollution can be defined on which level of pollution is tolerable. The same is for banks. So in reality, you don't know if it is good sometimes to allow a bank to fail, or maybe to save a bank, because that in reality can spread systemic risk. And then always in banking, this line between temporary illiquidity and insolvency is very thin and is very difficult to be evaluated. So in reality, the point of view of a regulator should be to step in when it's not too late, but not also when it is too early. Because if it is too early, in reality, you are spreading rumors that the bank has troubles and you can generate your own systemic risk. But if it is then too late, in reality, then systemic risk already is within the system. So it is quite difficult. And all these international banks that they operate then cross-border, they are more international once they are alive, and they are national once they are dead. Because still today then, depending on the bank where is located the headquarters, that will be under the supervision of the domestic authority and under the application of the bank insolvency rules of that country. So bank insolvency is not international. Still, bank insolvency is something that will be national. And that is one of the problems, because of course then some frameworks, they are more permissible, others they are more difficult to be conducted. And so even there, harmonization in that sector is another problem. Any question that you might have? And here you have the single slide that in reality is taken from the Council of the European Union, and here you can see how this system works. And here today we examine especially what was founded, set up in 2011, that is the European Securities and Markets Authority, that is based in Paris. So then another point, this is more practical. In reality, if you work for an agency of the European Union, you don't pay taxes as an official. So they have a privilege in comparison to normal citizen. In all the other companies, you pay taxes in a normal way within that state, within the taxation level of the state. In the case of ESMA, EIOPA, EBA, and every other European agency, all the officials, they don't pay taxes in reality. So what is ESMA? ESMA is an independent EU authority established, as I told you, in 2011, together with these other two authorities. The core mandate, as you can see, will be always the same, is to enhance investor protection, promote stable financial markets. So those are more primary mandates, but something that then in practice we will see is very difficult to obtain, because we don't have in Europe, as the previous slide was saying, this centralization of power. So ESMA is not the Securities and Exchange Commission. ESMA is not the Financial Conduct Authority, CONSOB, and so on. Does not have a centralization of power. Does not have direct supervision apart from specific areas that we will see then today. And in fact, these areas are credit rating agencies and trade repositories. So credit rating agencies, we have one lecture with me on credit rating agencies. So this slide is fundamental, because you should remember that ESMA, at least in Europe, has this direct supervision, but not in other areas. And then as direct supervisions, especially after the global financial crisis, on trade repositories. Why on trade repositories, and why also on credit agencies? In reality, they are interconnected, and the reason is within the global financial crisis. Why? Any idea? Why ESMA has this direct power of supervision in relation to credit rating agencies and trading repositories?
Maybe considering its historical background in crisis, they are trying to avoid bad practices by this type of
Yeah, essentially, I mean, from the global financial crisis is because there were problems with credit rating agencies, Standard & Poor's, Moody's, Fitch. Those are the three main credit rating agencies. There was a problem. What is the problem of credit rating agencies at the time of the global financial crisis?
Incorrect risk assessment of the intermediaries and CDOs.
Yes, they rated some financial instruments, in that case CDOs, collateralized debt obligations, as AAA. So in reality, they said that there was a high level of solvability and all the financial system was trusting that essentially if I bought CDOs, they would was unlikely that they will perform bad or even collapse within the position. That is something that in reality was not true. So those credit rating agencies also, they were in conflict of interest. There was a conflict of interest because they were giving rates to the same clients. And so this is something that then was addressed. In Europe was addressed with the regulation. So there is a regulation directly applicable to all the member states of Europe that is imposing some monitoring requirements on how this rating is conducted and for whom you can conduct the rating, otherwise you are in conflict of interest. And then trading repositories. What is a trading repository? Trading is from financial markets. So every time that I buy stocks, and I do this through Barclays, even Barclays as an intermediary, they do have a trading repository. If then there is someone that is asking how many securities of Apple I bought in the past, there is a list and there is a trading repository. So that is the main function of trading repository. The problem is to have transparency in data, because this is a collection of data that is not always transparent. Why transparency is important? In order to monitor systemic risk. And in the case of the global financial crisis, this was not transparent because there were a lot of CDS, CDOs, they are all derivatives. If you take with us derivatives as a course, derivatives and risk management we teach in the summer, we will see the role of trading repositories, and especially post-global financial crisis, the role of central clearing counterparties. So these central clearing counterparties, they need also to keep this trade repository, and they need to communicate all the data in a transparent manner to regulators or to standard setters, because of the international financial architecture. For example, we find the BIS, the Bank for International Settlement. The BIS is the one that is monitoring, for example, the OTC market of derivatives, where CDS are traded, credit default swaps are traded there, or even interest rate swaps as a normal vanilla financial derivative. It is traded OTC, over the counter. So there is, and this is something that we said at the start, I think, a difference between regulated markets and OTC markets. Regulated markets are regulated venues, so they have more rules in place, and there is more monitoring. In the case of OTC, this is less burdensome requirements, and so in reality there is less control and also less transparency. To increase transparency, now this data, they need to be shared with or standard setters or regulators in order to understand how the market is moving and whether the level of trade can generate systemic risk. So we need always to avoid systemic risk. There is always this kind of contrast between microprudential supervision, macroprudential supervision. So before, those things, I mean, were not seen a lot, but today is the new framework in regulatory frameworks, that we need to look at the single entity, but we need to look also at the macro level. The same approach is within MiCA, the crypto asset regulation for digital assets in Europe. It is a regulation, so now I think you understand it is a regulation because it's directly applicable. Everyone now is following MiCA. but MiCA is imposing liquidity requirements, capital requirements, authorization, all those kind of requirements within a framework of micro-prudential supervision for the single entity. If I am a stablecoin provider that I'm offering stablecoins in Europe denominated in euro, I need to comply with MiCA. But if I am a stablecoin provider that I'm offering stablecoin in Europe and they are denominated in dollars, no. So MiCA is overlooking what is specifically related to a macro-prudential supervision problem that might in reality emerge one day, but we don't have still today in Europe a framework. While other countries like the UK that today is outside the European Union, they imposed, still today we don't know because it's only a consultation of the Bank of England, but the consultation of the Bank of England at the end of 2025 has imposed specific requirements saying that, for example, individuals they cannot hold stable coins denominated in sterlings for an amount over £20,000, and businesses within some millions. They cannot have more than that amount. And that is done also to avoid macro prudential issues, like the fact that maybe a lot of depositors, they might switch from deposits into stablecoin, and this can generate maybe a bank run. So that is more macro prudential supervision. So while the UK has put some thoughts in this, EU didn't do this, for example, not today. So this is the system how it is designed. In the case of securities laws, I mean, if we speak about the prospectus regulation, that is directly applicable to everyone. And then within markets, we can have different kind of market segments. So for regulated markets, they will follow the prospectus requirements and the prospectus regulation. But then, if there is another market segment, usually a trading venue that is a multilateral trading facility, so the multilateral trading facility is another concept from Europe, and that relates to markets that they are still regulated but less in comparison to regulated markets. In that case, you don't issue a prospectus, you issue a disclosure document, so an admission document, and that is something that, I mean, you have less requirements. Maybe you don't need 3 years of balance sheet, you need only 1 or 0. And that is why, for example, an instrument that we will see at the end of this course through me, that is the special purpose acquisition companies, the SPAC in Europe, they were at the start all listed on the AIM market, alternative investment market, because there was not this requirement, for example. And the SPAC is a cash shell company, they don't hold assets today, they don't have a balance sheet in the normal standard sense, and so on a regulated market they could not be listed under the prospectus requirements, but they could on alternative investment market that was a multilateral trading venue. The main difference is that once you have different market segments, while on the regulated market you can maybe raise a high level of capital even in the region of, I don't know, 300 million, in the AIM you cannot do this. You can only raise that is designed for small medium enterprises. So in reality you can raise maybe 100 million, 50 million, 70 million, much less than a regulated market. So that is the main difference. But it is also why then the disclosure has to be less, because one point is to issue maybe $500 million on the regulated market, and so you might damage investors more. One thing is to issue maybe 70 million, that you will not damage investors in the same way. Then many times on the alternative investment market, this kind of issuance of securities, I mean, are directed to not retail investors but to institutional investors. So we said also the issuance of securities regulation in the world is based on this level of sophistication of the investor. If it is a qualified investor, they have enough capital to cover the loss, and they have also enough information to know what they buy. If you are a retail investor, you don't have usually enough capital to cover your loss, and you don't even have enough information. So that is why on the alternative investment market, because there is less disclosure, many times they avoid to offer this to retail investors. Something that is not the same, for example, in the US. In the US it's more free, so in reality in the US even a SPAC and the securities of a SPAC post IPO, they can be bought and then traded by retail investors. And because they were investors that they lost a lot of money, then there was a critique on SPACs, because the regulator didn't have in reality a framework to protect those investors. But that in reality is based on the same principle of US securities laws, where you can buy as far as you are informed. But it's not then the job of a capital market to make you rich. If you know how to play the game, you will become rich. If you don't know, you will sustain the loss. As far as there is information, so the principle of disclosure then is always important. Then coming back, ESMA does not replace national competent authorities. In fact, I told you, even in the graphic, those are always at the bottom, but they still supervise the single entity, and also they carry out macroprudential supervision. And ESMA operates within this model of shared supervision. So in reality, for example, situation within European Union, they must be communicated. So this is something that is since the time of BCCI, and I think we spoke in the 90s. In the 90s there was this bank based in Luxembourg and failed. The main operations were here in London, but this failure of BCCI then in reality blew up a model where the Bank of England did not supervise directly BCCI for over 20 years. And so they started to understand that consolidated supervision, shared supervision, communication between supervisors is key. So many times ESMA will write or enter into memorandum of understanding with national competent authorities in order to know directly if there is maybe a securities firm that can be a mutual fund, an hedge fund operating in Italy that is going to collapse, but in reality maybe can generate systemic risk. Also ESMA has to be informed, because we are here at the international level. So there are also within the European Union specific funds also to reimburse investors, retail investors, similar to banks. So the system that is in banking is in securities. Europe is quite simple in this way. I mean, they design systems in parallel. The idea is always the same. If someone is sustaining the loss, I am a depositor, there will be an insurance scheme. In the case of the banking union, we said that this was never achieved, but still does not mean that if you are a European depositor, you sustain the loss. The national authority will have its own agency within the domestic state that will insure you for the amount of 100,000 euros, because that is a resolution mechanism, that is a crisis management mechanism. Deposit insurance is a crisis management mechanism that is agreed by all the member states of Europe. So the idea is just to, with the European deposit insurance scheme, to take off some burden from some states that maybe they are not so rich. It's not the problem of Italy, France, Germany, Austria, other states that are richer. It's more a problem of Eastern European countries that they joined the EU, but they were before within communism. They needed to rebuild the economy in capitalism. So in reality there the flow of money is very different, and also the system of banking is very different. They might sustain losses, those retail depositors, that are much higher in comparison to Italy, France, Germany, and other member states that they found, even Belgium, they found the European Union at the end of the day. Any question? So the same kind of system of insurance for banks is also for intermediaries, because also an intermediary can generate systemic risk. Also an intermediary can generate losses through millions of retail customers. Because if you think, and I think Douglas spoke to you about mutual fund, what is the difference between a mutual fund and a bank? I am a retail depositor. I can deposit this money in the bank, but if I deposit there in a saving account, I will generate an interest of 1.4% HSBC today, or maybe 2%, Barclays, I mean, it's quite low, the percentage of interest that they give you. In the case of a mutual fund, it's different because you will deposit maybe 20,000 pounds as a minimum threshold if you don't want to pay in reality service charges to the mutual fund. Otherwise they charge you. You can even deposit 500 pounds, even 3 pounds you can do, but then you need to pay charges every month to the mutual fund. In the case of 20,000 more, you don't pay these charges. But then with that money, they invest in capital markets. So usually they give you also different kind of guidelines. Each one of these mutual funds has one. Fidelity also, one of the most important mutual funds, they have one. And they tell you in which kind of categories you want to invest. ETFs or maybe direct securities, but the risk is higher. So they need to evaluate your risk profile to understand how much risk you can tolerate. If it is high, you can lose everything. If it is medium, you can gain or lose, but the profit will be in the medium range. And then if it is a low level of risk, of course, you will not lose, but you will not earn a huge amount of money. It will be similar to a saving account. So there is no difference. You go in a mutual fund because you want to expose yourself to risk, and maybe you don't have time to evaluate the market. Otherwise, you can do alone. In this country, if you go in Barclays, everyone can open in a bank account the Investor Saver. The Investor Saver is a function with Barclays, and you can directly, invest in securities, whatever you want, in bonds, in equities, in ETFs. So in reality, even in commodities, ETFs that they mimic the price of commodities like silver, gold, platinum, oil, whatever. So that is something, but you need to do at your own risk. You need to understand the market. If you understand the market, in reality, can be quite good because you can make profit. But of course, on every capital gain that you make, so for example, now aristocrats, they are trading at 10% more, you might sell what you have, you might make money, but you will pay the capital gain, of course. So at the end, you don't take 10%, although that is the trading volume, you will pay a percentage of taxes, for sure, plus little percentage to Barclays. All clear? Now, this is the reference, legal reference, how ESMA as an agency was founded on this regulation number 1095/2010, and then operating in 2011. And then ESMA is a constitutional innovation because it's an EU agency that has quasi-regulatory power, quasi-supervisory powers, but they don't have a direct supervisory power unless it is trading repositories and credit rating agencies. There is direct, but apart from that, they are not direct supervisory powers. Because of politics again. The problem is that, there might be national forms within member states that don't want to be under the supervision of ESMA. They want to be under the supervision of the national regulator. And this is something that, is within this conception of sovereign states. If I am a sovereign state, I am part of Europe, I cede, I gave away some of my sovereign power, but other power that is related to how you make full governance of capital markets usually stays with the state. And so that is why there is this conflict. A conflict that in reality then we will see now with time, with stratification of rules, is more towards an opening of the market. So in reality, a position where Europe would like to mimic the US, would like to become centralized. Although this full centralization will never exist because essentially the problem is the member states and each one has its own enforcement. So for example, in a thing like even market abuse regulation, it is a regulation, it is applicable to all member states, they are defining within the regulation insider dealing, but then how you punish insider dealing can differ still in enforcement in each member state. So some people in some countries still today they do more insider dealing, in others that are more strict they don't do, or they are less prone to do, because maybe the consequence is 25 years in jail. And that is something that is dictated by statutory law at national level. So that is the main problem of Europe, that we have an enforcement that is not in reality in line with what Europe would like to achieve, that is harmonization. But still, this is the idea, this kind of trend towards harmonization is what matters in order of unifying Europe. Otherwise, we will never achieve unification. And here you have the main regulatory powers of ESMA, so regulatory, supervisory, emergency, coordination powers. The first one is quite important because it's the one more related to regulation. So ESMA develops these regulatory technical standards. So there might be, maybe as here in the example, the MAR, the Market Abuse Regulation, the Prospectus Regulation. Those are the rules designed by the European Parliament in conjunction to the Council. Together they issue, they enact the regulation. But then to implement this regulation and to give also more authentic interpretation to what some provisions mean, we need to wait ESMA. And ESMA is designing these regulatory technical standards that then are adopted at national level by all the member states. So that is the idea behind why we need this European agency. We need this European agency to promote unification, through unification of interpretation of the rules enacted at international level. Make sense? In reality, it is quite complex because, I mean, if you don't know European Union, but we are trying to make it simpler in reality. Then ESMA exercises this direct supervisory authority over specific entities. And this is something that I already told you, the credit rating agencies and trade repositories. And this is something also that changed, because before it was not like this. This changed from the short selling case that generated here in the UK. And now there are slides on this. And ESMA, in fact, possesses these emergency powers. So today, the powers of ESMA are in reality wider. They are wider because in a time that is not so long ago, they exercise one emergency power in terms of short selling by directing a ban of short selling in Europe. And that is something that in reality they could not have within their statute, within their regulation. They could not do this. But then the European Court of Justice said, yes, you can, because this is an emergency situation. It was a moment where everyone was shorting European securities after the global financial crisis, and so if you go short in a position, you bet against the security, it means that in a period of crisis or a specific turmoil like the global financial crisis, in reality can disrupt the market. The same was true even at the time of Monte dei Paschi di Siena in Italy. So for example, their securities of Monte dei Paschi di Siena, after the restructuring of the bank, there were a lot of positions that were taken by hedge funds to short the securities of Monte dei Paschi di Siena, because there was a moment that was not certain if Monte dei Paschi di Siena could be saved or not. If it was not saved, in reality, if you short the position, you make more money. But in reality, in that case, was the CONSOB, was the National Competition Authority in Italy that issued a ban on short selling. And all this is based on this famous case of the short selling case at the European level. And ESMA then promotes supervisory convergence. In reality, convergence, that means convergence of all these national competent authorities. So in all member states of Europe, we have different authorities in securities regulation. If we need to understand, maybe in Italy, they don't understand what does it mean a provision in the prospectus regulation, they will communicate, the regulator of Italy will communicate to ESMA through a Q&A. So asking what kind of law we need to apply here, or what is the meaning of this provision. And ESMA will answer. So in reality, it is a filter below the European Court of Justice. Otherwise, every time you need to wait national litigation, and then from the litigation, the judge will refer the case to the European Court of Justice that will give authentic interpretation of a European act. So ESMA is a filter to not overburden, in this case, the European Court of Justice, essentially. This kind of process, that is the litigation on national level, that goes in case to the European Court of Justice, is called preliminary reference. This is not a course of European Union law, but this is how it is technically called. And the European Court of Justice, in reality, is not deciding on the case, on the matter, subject matter of the case, but is giving the actual authentic interpretation of the European Union law provision, so that the national judge, in that case, will be aware of how he needs to apply the law. Even this process of preliminary reference, in conjunction through the filter function of ESMA, it is a way to promote unification of the law. It is a way to promote coordination of or convergence of supervisory practices. Make sense? And then it's issuing guidelines, opinions. For example, there was a famous opinion very recently, I think it was 2021, 2022, about SPACs, even there, because they didn't know which kind of law we need to apply. We need to apply maybe the directive on alternative funds, or maybe the fund manager directive. This is something that they didn't know, because the SPAC was a cash shell company, but still, with the money collected, like a mutual fund, they were investing the money in something else. So in terms of function was similar to a mutual fund, but a mutual fund is an operating company, the SPAC is not. And so this kind of, for example, dilemma in interpretation was solved by ESMA. ESMA said that no, you don't need to apply that, you need to apply company law, and you need to apply listing requirements in each jurisdiction. But ESMA was very, in his opinion, said that each exchange in securities laws in Europe should have within its own exchange some minimum requirements. This is a practical way to promote supervisory convergence, but also in reality to promote uniformity in listing requirements, because otherwise we might have people that only list in Amsterdam as SPAC and not in Italy. So today it is more uniform. Every exchange will know that, for example, all the money collected by the SPAC must be kept on trust. They cannot be touched until there is a business combination. All that money, they must be used for that purpose. All that money, they could be redeemed, for example, by investors. If the investor doesn't like the business combination, has the right to redeem. This was not so, in reality, certain in Europe until this opinion. And so today, with this opinion, we know. Although opinions, Q&As, guidelines, reviews, peer reviews, they are soft law. So still, this is not directly applicable in the sense that it's not enforceable in each member state, and each member state can do whatever they want. They might comply with that, or they might not comply with that. Usually they comply with that. But it's true that still today, in SPACs, Spain has a position that is different from Amsterdam. This is the reason why many SPACs still today, they list in Amsterdam, Euronext, and not on the Madrid Stock Exchange, for example. So, although there are these instruments, this is the main message to give, is that does not assure you that the final result of harmonization is there. This is just a step, it's just something, an effort, but then in reality you still have today forum shopping in Europe in terms of securities laws. You still have it. Of course, securities laws is very particular in the sense that the decision to list in one country, not another, on a market that is Euronext, is based on liquidity of the market. So for example, in Europe, within securities laws, because we are really in Europe now, speaking about European Union, in reality Euronext is a pan-European market, financial markets. So there are different exchanges, Paris, Amsterdam, Milan, they are all interconnected, Belgium. And so if they are interconnected, it means if I list in Amsterdam, I can also delist and list very easily with less requirements in Belgium, or I can carry out dual listings, or generally saying I can access more liquidity in comparison to go on Frankfurt Stock Exchange. That Frankfurt Stock Exchange, only after, for example, the opinion of ESMA, they had now some listing requirements for SPACs. But still, in the case of SPACs, maybe there are problems in terms of company law in Germany that does not recognize this role of non-operating company. And so that is another problem. So, as you can see, the framework is very complex because we have opinions that are coming from international level, standards that are designed from domestic level, and then practices that they might differ between member states. If all member states they follow the opinion, there will be more convergence. But it's also true that it's not compulsory. So in reality, there will not be something that is 100% sure that this will happen. And this is the famous case, and after this maybe we can call a break. This is the famous case of the short selling case between United Kingdom and Parliament and Council. So in reality, in this case, ESMA directly imposed a ban on short selling. Usually is not within its own powers, but the Court of Justice said that is an emergency situation, emergency power was exercised, and this could be possible. But this kind of behavior of ESMA giving a ban in reality is against a very famous doctrine within European Union law, that is the Meroni doctrine. For example, I was this summer in Austria, in Salzburg, and there they carried out a course on the European financial system of supervision. So in reality, what I'm teaching you is taken also from that course, where there were officials from European Council, European Parliament, ESMA, and so on, that they were discussing those cases and how in reality in Europe, since the beginning of the European Union, we believe in this Meroni doctrine. So in reality, what is the Meroni doctrine? It is a case law in front of the European Court of Justice, two cases originated here in 1958. So those were at that time in front of the High Authority. The High Authority does not exist anymore, today is the European Commission. So what was called High Authority today is the European Commission. At that time was said that there are permissible powers that can be delegated to European agencies and unpermissible powers. Once the European agency has been delegated too many powers that can exercise in discretional manner, this is acting beyond its own powers. So in reality here you need to know a bit of administrative law and constitutional law. So Meroni doctrine said that you can delegate powers from the European Commission to ESMA, for example. You can do this delegated act, but the act has to confine in a precise way which powers are delegated and the discretion of those powers. If that is not the case, we are in emergency. This emergency sometimes can be justified, sometimes not, but still will be the judiciary power, that is the Court of Justice, to decide then the case. And that is the case where, in the short selling case, they decided that could be done for an emergency. But if we are not in emergencies and not in a normal context, any of those agencies, EIOPA, EBA, ESMA, and all the other agencies, because there are many, there are even agencies in food, in many other sectors, they cannot exercise powers beyond delegation. And they cannot use their own discretion because the discretion is given in the delegated act, essentially. Otherwise, they say you are acting against the Meroni doctrine. So one point is to have the delegated act that is giving precise powers, list of power and discretion. And another point that this can be legitimate is the fact that any act then issued on the basis of the delegated act must be subject to review by the European Court of Justice. So if the European Court of Justice has the possibility to carry out the review, that is a judicial review, as in constitutional law, of every administrative act. So if that is possible, you are respecting the Meroni doctrine. Otherwise, not. Make sense? So I think we can call a break. So we have seen now the ESMA, we have seen all the basics, and now we will go a bit more faster, I mean in Capital Markets Union, some final remarks. Thank you. Like, let's say 10 minutes. 10 minutes, yeah. Yeah, yeah.
Ma come la prossima settimana ci è assegnata una lezione dalle 6 alle 9 di securities parlo.
Sì, perché in poche parole facciamo o viene qualcuno a parlare, o se no, se non viene qualcuno a parlare è un seminario in realtà.
Ah ok, quindi è un'ora.
No, possiamo pure farla di più. Là è segnata per 3 ore. Se faccio venire anche uno, ci sarà una mini lezione di qualcosa, altrimenti no.
Professor is writing to lecture us in Sir King's College, right?
Ah,
It's
yes,
very
yes.
helpful. And actually cited your paper in my
Ah,
essay
very good.
assessment. So if you are conducting any more events like this, please
I will let you know.
You mentioned specifically with regard to unregulated market.
Yes.
So ESMA and other authorities controls the publicly regulated market. But when it comes to the private equity, what happens? Because
What happens to what?
the private companies? Because I'm not from Europe.
Yes.
I don't know how the legislation works. So in
Yes.
India, if you have a publicly listed company, just like ESMA, there is SEBI. SEBI regulates the securities exchange. But in terms of private equity, wherein you're not publicly listed, there's no specific regulation, but there are entries to barrier. So let's just say you are more than 2 crores, then you have to be listed. But in terms of private companies, how is it related?
No, but here in securities regulation we speak only about public companies. Only public companies.
Because you mentioned
Because private companies are private companies, they are not listed on the stock exchange.
yes, but you mentioned, I think in between
Yeah,
the lecture,
what
you
I said.
mentioned something related to private or company that is not under the scrutiny of the regulators. In between,
Yeah, they are not under the scrutiny of the regulator.
yes. So how do they form? Is it based on independent contracts between the parties, or is it?
It depends, like I mean, here the subject matter of this course is securities regulation. So are only securities listed on the capital market. So in reality, if you are a private company, your securities are not listed on capital market, so you cannot be subject to all these rules because you are not on public markets. So as a private company, I know you produce biscuits. Yes, it's all governed by contract law. Yes.
That's it.
Yes, that's it. There's nothing related to what we study here. Because here we study only companies that are listed on stock exchanges. So yes, there's no confusion. I mean, they are not here. They are not.
Reasoning why I asked this is because I wanted to know, apart from, because in India, public listed companies, they come under the scrutiny of the regulators.
Yes, even here.
Here also it's the same principle.
It's the same.
But if it's a private company,
Yeah.
even though they don't come under the scrutiny of the regulators, there are some entry and exit barriers in terms of how many shares they can give out or how many.
Yes, but that is another thing. Can be golden shares or foreign investments. Yes, in India there are some barriers, legal barriers. Here also in Europe we have different member states with different rules.
So is it regulation like from a foreign exchange management is the investment guidelines in India?
Foreign, exactly, the same is here, but it's about this foreign exchange management laws. I mean,
Is it like a directive in Europe, or is it like a regulation where every member state has to come to it?
it is like a regulation.
Or regulation?
Regulation. It is a regulation, yes, it depends, but it is not part of this course because it's something related to golden shares. other things about M&A, for example. It's contract law.
Understood.
Then there is a law. Each law is different from each member state.
Yes.
Yes, yes. But it is about private companies. I mean, they are not part of this court.
Alright. And the second part of my doubt is you mentioned with regard to this is also not part of this course, but in terms of the judicial structure, you mentioned there is CJ, Chief
I mentioned?
Chief Judicial Court or something, apex court for the entire union.
What I mentioned?
In terms of courts,
Can you come that I just...
court wherein disputes are resolved. I'm sorry if I'm bothering
No,
you
no.
my elders, because I don't understand how the system works in that's it.
No, no. No, with what we do. Yes, I will explain that. Then we see, I mean, what we cannot cover today, but I think we cover. But in case we cover once we meet again. But after me, I mean, after the reading week, you have Douglas. So, no, you have, yes, now I will say next week on Monday, you have 3 hours seminar. It's a seminar, it's not a lecture. So next week on Monday, it's not in your timetable. It's not in your timetable.
It says Tuesday.
It's Tuesday. So it's Tuesday. Okay. Maybe let me see.
Can I ask a question? Do you have any idea when the essays?
Yeah, during the last lectures at the end, yes. So if it is Tuesday, it is on the 3rd. On the 3rd, yes.
It says it's a 3-hour tutorial.
3 of March.
Yeah.
Okay. Yes, I think it's right, yes. But that is a seminar. So in reality we go in a seminar, or maybe there will be a guest lecture. No, it's not compulsory.
Yes, for one more.
Okay, I think we can start again because we have some ground to cover, essentially. So all these slides that then you see, they relate to the Capital Markets Union. So we spoke before about ESMA, European Securities Markets Authority, as an agency of the European Union. But this agency of the European Union sits within this idea of the Capital Markets Union. As the European Banking Authority sits within the Banking Union, the ESMA sits within the Capital Markets Union. They both, in reality, are a response to the global financial crisis. The Banking Union to the global financial crisis, the Capital Markets Union to the global financial crisis. But in the case of the Capital Markets Union, we have also this kind of diagnosis. So they saw that the European economy is dependent on bank-based financing. Usually in Europe, we don't have big corporations. We have small, medium enterprises. So these small, medium enterprises, they rely on financing from banks. But what happened, once banks they are in a period of crisis, they tend to deleverage, so there is less credit for the system. So that is something that then was visible in the aftermath of another crisis, because there was first the global financial crisis, 2007, 2010. And then from 2010, 2012, in Europe specifically, there was the sovereign debt crisis. And so there we saw financial fragmentation, and so nations, member states, that they wanted to leave Europe. Was the time of the sovereign national crisis of Greece, and also the fact whether we need to still adopt a common currency, that is the euro. But then is the time also of Mario Draghi, where he was the president of the European Central Bank and said whatever it takes to save Europe and the euro. And that is where actually then the Capital Markets Union also was invented, created as an answer, strategic response to the crisis, the sovereign debt crisis of Europe. And so was launched in 2015. Before I go towards this, there was a question from you, and your question was related to preliminary reference, because you are not from Europe, and not only you, many others. So I come back to this concept because in reality it's important to understand this role of agency and national governments that are the member states. So within member states, you might have litigation. This litigation can concern securities laws. One securities law within the European Union is the prospectus regulation. For example, there is a case of an issuer in Italy that did an IPO, but maybe we don't understand in a very clear manner, because maybe there is a minority shareholder of the company that is starting this legal case against the issuer. And then there is an interpretation issue of one provision of the prospectus, whether it's not clear whether we need 2 years of balance sheet checked or 3 years. For example, this is not clear, imagine it's not clear in the prospectus regulation. Now, the national judge cannot take with its own discretion a decision on that case. He might, but usually he will not. Usually the main thing that he will do is that or the judge or one of the parties of the case will ask a preliminary reference to the European Court of Justice. So it means that the case from the domestic level will go here, in the EU level, where there is the European Court of Justice. The European Court of Justice will interpret and give the right interpretation to give to that provision of the prospectus regulation. With that interpretation, we come back again here in the domestic level, and the judge will decide the case based on that interpretation of the European Court of Justice. Make sense? So that is how, in reality, that is very important. Preliminary reference is an important procedure in Europe because through preliminary reference, not only you have more jurisprudence in Europe, but you have an evolution of interpretation of European Union law. So although then we issue one regulation in, I don't know, 2010, then if we look today in 2026, there are many years where maybe the European Court of Justice has issued a specific decision based on preliminary references of different courts from different member states. And through this, in reality, we create a jurisprudence where we know today how we should interpret that case. The main case is very important in the European Union, where in reality we could even develop a common market. And so, for example, the fact that there are no barriers, there should not be barriers in trade between member states, is from the European Court of Justice through preliminary reference. So even this idea of direct applicability of a regulation, direct applicability of a directive, is solved from the European Court of Justice through preliminary reference. Then there is another concept that is direct effect, but this is something, I mean, we don't need to discuss here because that is really European Union law, so you don't need this. And then coming back always to that question, this course relates to companies that are public companies listed on stock exchanges, so securities laws, because it's a body of the law that is regulating securities listed on the stock exchange. If you are a private company, you are not part of this course. That is the point. The main point is this. So in reality then, in a private company, everything is governed by company law and contract law. So those are the frameworks. Then of course, if two companies maybe they merge, if they merge, they might give rise to abuse of dominant position. So that is competition law. And that can even go here in the European Union, where the European Commission is the main actor of competition authority, is a competition authority of Europe. So in that case, if there is a merger, the European Commission will decide the green light of your transaction between private companies. So that is the only thing where, but in reality even that is not part of this course. This is just to clarify. Now it's clear, no? Okay. So the Capital Markets Union, as the Banking Union, in reality is not composed by one single act. There are different acts. These acts we will see today are the market abuse regulation, the MiFID directive. There are different kind of rules, the prospectus regulation, in reality all to harmonize the European securities laws within the European Union. Unlike the banking union, in reality we said already at the start, this system is not centralized. ESMA is not the equivalent of the Securities and Exchange Commission. But in banking, we see more this centralization of power through the European Central Bank. So European Central Bank has supervisory powers that they are direct for significant banks in all the member states. So those significant banks, they are no more under the national competent authorities' supervision. They are under the supervision of the European Central Bank. So that is something that you see within the banking union, but you don't see in the capital markets union. Although within the capital markets union there is always more a trend to mimic the US, as is saying here. So there was always an ambition very clear that in securities laws we want to mimic and to become like the US towards centralization. But this centralization cannot be possible because of Meroni doctrine, we said before. So in reality, delegation of power cannot be in reality in excess, or can be conducted within the parameter designed in those cases of 1958 of the Meroni doctrine. That still is applicable within the European Union. Even the Meroni doctrine was preliminary reference. So in reality, in Europe, all the application, interpretation of European Union law is based on this mechanism of preliminary reference, through which the European Court of Justice could give real, authentic interpretation to the acts of the European Union, secondary legislation of the European Union. All clear? Yes.
To Capital Markets Union recently, last December, was published the market integration package. What this direction, savings, capital savings unit, like that. What are the major lines of reform?
Yes, and this is something that then I think is discussed here. Yeah, in this one. So, for example, that there is a feature of the European economy that all the deposits, all the money usually are kept in deposits at the banks, and they are not invested in capital markets. So we have a huge amount of savings in banks, but we don't have this amount of money that is circulating through capital markets that they are cross-border. So that package of measure, for example, is one recent package that in reality on the line of the UK, because also in the UK they conducted, for example, an inquiry on non-bank financial intermediation, and they started to see that there is also here this trend. Even the government, the Labour government in this country saw this trend that a lot of people, they tend to keep the money deposited in the bank but not to invest the money on the capital markets. And so to encourage this, they, for example, in this country, impose higher taxes on saving accounts. So that if you have, no, £300,000 in saving accounts and you generate an interest rate of 3%, the capital gain now is taxed in a consistent manner. So that is done because indirectly, if you want to skip and avoid the tax, you go to invest on capital markets, where maybe the capital gain tax now is lower in comparison to saving accounts. And that is done because if this money are circulating through capital markets, the economy is circulating better rather than keeping all those amount of money within a bank. This is a problem that, is more related to Europe because we don't have this kind of culture, investment culture like in the US. This is something that I told you at the start. The US has a model that is directly in reality towards the investment in stocks, in bonds, mutual funds, and so on. So less people they keep money in the bank, or less people they buy real estate in the US. In Europe, wealth is measured by having 3 houses, 4 houses, so reality by having real estate and by keeping money within the bank. This is another mentality. You are less a risk taker, because in capital markets you can earn much more money, but you can even lose much more money. In the saving account of a bank, although it's giving 1-2% maximum of interest rate, that is certain, is less of a damage. But still, one day that is the big question, if there are stablecoin providers in this country or in other countries that they promise maybe higher level of interest rate and they are giving you an equivalence parity of exchange one-to-one to the money that you deposit through the stablecoin provider, will then the depositor still keep this money within, for example, the bank, or they will switch from banks to stablecoin providers that they are non-bank financial intermediaries? We don't have the answer, but might be a possible question. Although in Europe no one will switch for this, because the population of Europe also is old. So an old person will not go on the mobile phone to open a digital account, maybe an app, and then deposits all this money within this other provider. I mean, it's something that is on the paper in Europe. Also because we said stablecoins 99% are denominated in dollars, not in euros. So it's not a problem still of Europe. But it is a problem, the fact that many people in this economy within European Union, they tend to deposit money in the bank and not to invest on capital markets. So one objective of the Capital Markets Union is also to facilitate the circulation of capital among capital markets venue. That is another way in parallel to banks. That also depends, of course, on the level of wealth. So in reality, I mean, not many people, they have 300,000 pounds on a bank account. Very few people in reality they have. So this kind of problems, they are there for the market economy, or to boost harmonization, or to have there as an idea once many people they will reach that level. But still we are very far from that level in practice. In practice, even in the UK, apart all generations, new generations, they don't have a massive amount of money deposited in a bank account, and they don't even have enough liquidity to go on capital markets. So everything is relative. Very few from even rich families, they have this opportunity. Others, I mean, if you start a job in London, you don't earn massively. It depends on the job, depends also on the years that you work, depends what you do with your money. Now even the level of spending is different from the past. In the past was more into savings. Today maybe everyone is on Instagram and has to travel everywhere. So it depends. It's something that, of course, in official reports they cannot write this. So I mean, but it's something that every one of us knows what is happening in reality in younger generations. That is very different from the past. What they refer here is to all generations, from our father and mother to our grandmother and grandfather, that they build up in reality this kind of system based on real estate and bank deposits that actually today should change in order to give more liquidity to the markets. Why you need more liquidity? Because if your capital markets has more liquidity, more people they will invest, and more people they are even willing to issue new shares on your market. In the US, in fact, that system works very well because in their conception they have a risk tolerance much higher. So in reality they want to take risk, they want to invest, and that is something that was always there since the crash of Wall Street. So that is completely different, and that is why still today they are very liquid markets. This is why New York exchanges are prestigious. Everyone wants to go there to access not only the prestigious of US, but also prestigious of having more liquidity, more investors. That I know very well that if I go to list something on New York, I will complete that listing very likely, even if the environment, economic environment, is more risky. If I go in Europe, the IPO market is crystallized, is stopped. Even in London there are no more listings, because no one wants to take this risk in Europe that once there is a possible war, once there are economic conditions that are not positive, no one wants to list in Europe, and no banker wants to take the risk. This is another point, because we said in the past, you need an investment bank to get listed. So not all investment banks, they do this. And many investment bankers, even in Europe, we had one that wanted to list in London. But in reality, then if you speak to bankers, the one in London, they don't want to list. The one in Europe, they said yes, but they want to list in their own member states, because now there is competition between listing venues. Before there was not this concern, but today is very real. So today, if you are from Amsterdam, you tend to say, come to Amsterdam Stock Exchange, Euronext. It's much better than London Stock Exchange. And if you accept this condition, they list you in Amsterdam, but you become a European company. Otherwise, you need to list in London, but you need to find someone that is going to list you. If they don't list you, there's nothing that you can do. So without investment banks, without investment bankers that they are willing to list you, that they believe also that there is enough liquidity in capital markets. So for this reason, they want to shift the bank deposits into capital markets, because there is more liquidity and more people that will invest in reality. You can shift this liquidity also simply by putting this money not in bank deposits, but in a mutual fund that will invest in capital markets. So, I mean, the way that you can do are direct or indirect, through even mutual fund, pension funds. So in reality, there are many ways that you can do this, as far as you don't put your money only in bank deposits. That in reality is true, because it doesn't make even sense. Even from a banking union perspective, the deposit insurance is up to 100,000 euros. So keep 100,000 euros in bank deposits and invest. Usually, yes, rich people, they invest on capital markets, so they don't keep 500,000 in bank deposits. But if you go in all generations in Italy, yes, you might find surprisingly also maybe 3 million on the bank account. But it's wrong, because essentially does not generate as an investment portfolio on capital markets. So in fact, there was, yesterday we were in a dinner, there was a person that said from JP Morgan that a JP Morgan CEO or director in the US said that if you want to retire today and you don't want to work anymore, if you have at least 2 million of portfolio invested in capital markets, this will give you an equivalent of 5,000 gross per month. So in reality, as you can see, is quite massive. This will not be generated by keeping 2 million inside a bank deposits. But you need something cultural. You need then to speak to people that are old, that they don't trust the market because they think that they can lose money through the market. So this is something, one objective of the Capital Markets Union is to generate this convergence, this cross-border also activity of money, circulation of capital, that is also part of the freedom of capital, because in Europe we have different freedoms, freedom of circulation of people, circulation of capital. So those are fundamental freedoms of the European Union that are based on the fundamental treaties that are the primary legislation that I was telling you before. I addressed, I think, the question.
Yes.
So, yes, and here we can go, I mean, quite quick. Here in the slides you have everything essentially. So without having a book, you can read from the slides that essentially the first action plan was 2015, then there was another in 2020. So all this is a sort of stratification of rules. And here you can see the early review, for example, of the prospectus directive that became the regulation to promote harmonization, as we said, direct applicability. Then also a revival of securitization after the global financial crisis, an adjustment to venture capital regulation. This is another problem of Europe. We don't invest in startups. We don't have enough number, sufficient number of startups to be competitive to the US in California. But that is also directed by many things. For example, with Lastra we did a sort of research very quick because we needed to answer something from the Lords, House of Lords here. And they wanted to understand why venture capital regulations are better in the US and worse in Europe and the UK. It's because of this investor mentality, first of all, so risk tolerance and risk taking. Here there is not in UK, not in Europe. So less people, they are willing to say, hear your idea, and then sponsor you with a round of financing of 100 million. In the US you can find. In the US, I mean, also when I was there, I didn't live there for a long time, just 2 weeks, 3 weeks, but in 2 weeks only, between Boston, New York and so on, I find out that, I mean, like movies, you might find the vice president of Morgan Stanley that is asking you a cigarette. Here does not exist this thing. There exists. He can connect you with someone else. Someone else can say, okay, I will give you 20 million. There exists this thing. Here, no. No one is doing this. So that is also why venture capital, if you want to know more, we will do and run another course that is investment banking, private equity and venture capital. That is a new course for this year in the summer, and there we can speak more about this, essentially. But venture capital is another problem of Europe. This was also highlighted by the Draghi report. It's a problem of Europe because we are not competitive. We are not only non-competitive in the hyperscalers, so Amazon Web, Microsoft, Google, that they manage the cloud services. We don't have an equivalent, we don't have an alternative. We don't have an alternative in payment systems. Visa, MasterCard, they are all Americans. We don't have enough money to fund venture capital initiatives. And that is not only a question of rules and regulation, it's a question of law, a question of mentality and risk tolerance, and a question of application of the law. Because then another point in the US is that they have a specialized court that is in Delaware court, that they only issue decisions for companies. So they are more specialized. If there is a problem in venture capital, they already have a lot of jurisprudence there. Here is variegated because in domestic level in the EU there are 27 member states. In fact, I told you at the start, here the problem is enforcement, here the problem is application of the law. Interpretation of the law, it is sorted a bit with the preliminary reference that we explained before. But application and enforcement, no. You might have different sanctions in different countries, you might have different applications in different countries, and so in reality the jurisprudence also of the courts, they differ massively between France and Slovakia. So it's normal that then maybe venture capitalists, they go in France, not in Slovakia, but also in France, what they can offer. Here is a question to be competitive. If Europe cannot offer a good environment that is also more solid than the US, everyone will always go to California, essentially. Also because there they have good cases of big corporation today that they born in California. So even you, as an entrepreneur, you prefer to go in California than to go in Europe. It's not only a question of the law and the application of the law. That is the main point. So it's true that one point that we can say is that this capital markets union, banking union, they are a manifesto. There are ways to say we need to be European, we need Europe because of banking union, we need Europe because of capital markets union, we need Europe because of common union of the trade, for example, trade union. But it is something that, I mean, each time is going to change and each time is not really going to be addressed 100%. This is why today, I mean, there is a crisis in Europe because they don't know anymore what is the new answer to the new question why we need to be together. Now they are trying to say that is common defense. As you can see, the thing that I told you is coming and will, if you look at this thing in this way, you will see it's always coming up. So in reality they always come up with a question why we need Europe, and they have always an answer about capital markets union, banking union, terrorism union, that we want to face terrorism together because it's a risk, a danger, an hazard for society, and so on. So common security, common defense, and so on. Let's see. Yeah, this we said many times about harmonization. This we comment now about the different perspective and how the capital markets union in reality includes then a review of investor disclosure, and improving financial literacy. For example, this improving of financial literacy is very important because many retail investors in Europe, they don't invest because they don't know what they are doing. So more financial literacy can in reality provide is actually the real practical tool through which you convince a person to switch from bank deposits, not keeping 3 million there, but using that in the economy through capital markets. But for doing this, you need financial literacy. I mean, in Europe, it's based on small, medium enterprises. So there might be people that even, I don't know, they make pasta since, I don't know, 200 years ago, and in generations, maybe they not always study at the university, they are more business oriented, and they don't care about financial literacy. So maybe, unless they don't trust a private banker that in reality is managing their wealth, this is another thing very different from the US, because in the US, once you reach a certain amount of money, maybe 500,000, 1 million and so on, you are contacted by private wealth division of investment banks. So they in some way drag your money into capital markets, they channel your money into capital markets, and they help you to do this. Here we don't have this culture, much less. Here even Barclays, even if you have some millions, they will not provide the same assistance that they do in the US. And so that is practically why in reality many people they don't do, essentially. Also because here is a system that is based on inheritance. So maybe this wealth is passed generation by generation. And so that is another point, that maybe the previous generation, the post generation doesn't want to use that money that are not truly their money, and maybe waste all that wealth on a security investment that then is going bad. So that is also an idea that is more family oriented in Europe, while in the US is less. Although there are big important families, but in reality they were always used to invest on capital markets. So Brexit, we said already, that is, I mean, giving this geopolitical dimension that is different within the capital markets union, because of course today everything that is, for example, in the UK they adopted a reform of listing requirements, and so in reality this reform that is quite recent, between 2021 from the Lord Hills report until today, that is 2025, they adopted a reform to in reality go in less disclosure requirements. If before there were 3 years of balance sheet, now 2 is sufficient. So they try to simplify. One point that we see that actually the UK is going in parallel with the European Union is it is simplification. So simplification is different from deregulation. Simplification is really to give this convergence of supervision, harmonization, intelligibility of rules, by also cutting some requirements, making the life of issuer easier. This is a way to legislate, and they think in this way to be more competitive. Trump is more extremist, so rather than simplifying, is directly cutting everything because it's deregulation. So deregulation, you really deregulate. If before there was a rule that was saying that, I don't know, investment banks, they cannot go into securitization, you scrap the rule. Now you can. So in short run, it's making a higher result and impact, because more people is looking at this as a true reform, and more people are willing to go to your country. In long run, it depends. We still don't know the effect of those reforms. You might have a concentration of systemic risk that is much higher and might explode in a way that is more prominent there. And that is why many times those crises are in the US and not in Europe. They come from the US and they spread in the world. But because US is based on this kind of approach, deregulation, risk-taking, different from us. So now I think in this course you have appreciated this difference that is not only in the law, because in the law we saw securities rules and regulation in the US are more devoted to help the issuer, primary markets, the Securities Act, the Securities and Exchange Act, in the UK, in Europe, is more into investor protection, how we can protect those mass of people that they want to invest but they don't know on what they are investing. As if in reality capital markets are devoted to make people rich, but it's not true. So that is the paradox of Europe or the UK. It's not the job of capital markets to make you rich. It's the job of the regulator to make sure that the trade is transparent, you are informed with disclosure, but at the end of the day it's your own decision to invest and even to risk all your money and to lose all your money. This is well known in the US, and so this is the reason why they protect it, or they protect. Their main focus is firstly on the issuer and then to the investor. Here is to the investor first and then maybe to the issuer, and this is why the issuer doesn't want to list here and they prefer to list in the US. It's very simple in reality. And so here is also telling you how within the Capital Markets Union ESMA is playing a central role. Why? Because we said that soft law power. So if there is an interpretation issue, the ESMA is a filter before we go to the European Court of Justice. So should in reality promote this kind of idea of uniformity. But still, ESMA does not have this supervisory power in direct way. They have only in that limited cases that I told you. Those cases, some people they think they might expand in time, but we need new emergencies, so it's more difficult because only through emergency and the exercise of emergency powers, ESMA can exercise its own power and so maybe dictate a ban, dictate a new rule that is applicable in all Europe, but it is something that is exceptional. So if we need to wait every time this exceptional event to then be sure that this system is going towards centralization, we will wait forever. So there is not in Europe today, from a legal perspective, something that can justify this centralization. Also because there are different arguments. One against is constitutional, that if we give more power to ESMA, and so ESMA becomes like the Securities and Exchange Commission, there is less independence and accountability of member states. So in reality, member states, they don't want to give up everything they have. They want to be part of Europe, but with some calibration. Otherwise, some other people, they think that this will happen, once we become a federation. If then Europe will take this step, probably through this common defense fund, and so the fact that we create a European military army. At that point, we might declare ourselves as a federation. If it is a federation, the European Central Bank will be like the Federal Reserve, ESMA will be like the Securities and Exchange Commission. So, and there will be a fiscal power that will be directed by a EU Treasury, where in reality then the member states will not even have the power to impose taxes, but they will in some way be aligned through this EU Treasury. Yes?
It's more of a theoretical question, but I don't think that it's possible for the EU to become a federation. Or it's going to take many years before that happens.
Yes. Yeah, me too, I think so. I think that, it's very difficult to be a federation for all the things that we said at the start. So in reality, this language that is not common, many cultural barriers, traditions, legal traditions, application of the law, bodies of the law, and probably the thing good in Europe is this variety. So it's a unique case in history that in reality many people they were thinking that could fail, but never failed so far. So even if now there was a Brexit, all the other 27 are still together. But still, you need to survive many crises. So if there is a new crisis in terms of security, if security is not guaranteed in Europe, many people they will prefer to be alone and maybe to leave the European Union. But there is not the basis of a true federation still are not there, maybe one day, but maybe we'll never see in our life for sure.
That's why it's more of a theoretical, like, parentheses,
Yes,
more than
exactly,
feasible thing that it could happen.
exactly. This is something that is much more difficult to happen. And here you have slides that we already, discussed. And here, this is the third bullet point, for example, we discussed, but this is what you find also once you need to review, so that even if you didn't take notes today, you have. And it's about these soft law powers of the ESMA, and how in reality those is still law, and sometimes can give direction into this supervisory convergence. Yes, here I wanted to, this also we discussed about the federation. These are the acts, the European securities law, because we said that it's not based on unified code like in the US. And so in reality we need to look at different legislative acts. They are all part of the secondary legislation. So MiFID is one, is a directive. Then there is prospectus regulation, then there is a market abuse regulation, and then there is the European Market Infrastructure Regulation, EMIR. The last one we will see much more in derivatives, because that is on derivatives market. So once there was the global financial crisis in 2007, 2008 in the US, after that moment, immediately there was then in 2009 a G20 meeting at Pittsburgh, and they decided in reality to have new rules for derivatives market. In the US, this was formalized in the Dodd-Frank Act. In Europe, in EMIR, in this regulation, and in fact by chance it is a regulation. But they said in the meeting of Pittsburgh, the G20, that one point of the global financial crisis is that there was not enough liquidity, and all these cascades of failures was due to the fact that on OTC markets, over-the-counter markets, there was not a central clearing counterparty. So there was only bilateral trading between operators. So if one party fails, who is going to pay? No one on over-the-counter, because if you are on exchange market, there is the exchange as a clearinghouse, so the exchange will pay the other party that is going to fail. If you are OTC, there is not this, there is no exchange, and so that is why we need a central clearing counterparty in derivatives. That is an intermediary between the parties. Derivatives are financial contracts, they are entered by two parties, and in the middle there is this intermediary that is the clearinghouse. And so in reality, every time that one party is going to fail because maybe it doesn't have liquidity to cover the position that are opened in a CDS that is triggered by a credit event, in that case it's possible that the party is going to fail, but then still the central clearing counterparty will compensate the other. So the one that bought the CDS will not fail anymore in consequence of the failure of the provider of the CDS that failed, for example. So that is a reform that was implemented in Europe through this specific regulation. But even the market abuse is a regulation. Even the prospectus is a regulation. So this is really to show that the Capital Markets Union and securities laws in Europe is based on regulation that are directly applicable. Here you have some summary, about what happened between banking and securities and the single rule book. This is something that in reality is generic because it's applicable in banking, it's applicable then in securities. So that is how you implement standards. You do this through European agencies that are the EBA, EIOPA, ESMA, and they usually issue these regulatory technical standards. So they are drafted set of rules that they implement regulations. Some may be provisions of regulations that they say that we need maybe certain parameters or a table of comparison, something that is more technical, will be elaborated by ESMA. So you don't find this in the rule, in the regulation, you find this through these regulatory technical standards. For example, there is DORA. DORA is a regulation about the resilience of all these kind of cloud operating service providers. In that case, because all the banks, for example, they rely on cloud services, but if those cloud services, they are all Americans, and then at some point Trump says, stop the operation with Europe, it means that all the data that are managed by those cloud services providers are lost immediately. So the bank has to have a backup plan, but in addition to this, under DORA, the EBA, that is the European Banking Authority, is going to, for example, enact regulatory technical standards in order to have then a list of which banks they use which operator and which bank has a backup plan. All this information then, as a regulatory technical standard, is passed to the European Central Bank, and the European Central Bank can directly supervise or better supervise those banks to avoid systemic risk and geopolitical risk. That is the new thing. So I think even Douglas told you that this is something in evolution. Before, during the global financial crisis, there was a lot of stress on systemic risk. Today, the higher stress, bigger stress, is on geopolitical risk. And so that is something that can be seen in these regulatory technical standards designed by the European Banking Authority in banking, or the European Securities and Markets Authority in securities, where they need to, in reality, direct some data, and this data, they need to be shared with supervisors in order to make sure that supervisors, they can monitor the situation in an efficient manner. MiFID, in reality here, I mean, we spend not too much time, but in reality is a directive, and this directive that must be implemented by member states is going to govern financial instruments in Europe, and especially even trading venues, regulated markets, multilateral trading facilities that are the alternative investment market. So in some of those markets you have higher requirements, in others you have less requirements in terms of disclosure. It's all regulated through MiFID, and especially MiFID is giving also reporting requirements. So now all these intermediaries, they need to have a transparent management system of data that is transferred from the intermediary to the supervisor. In this way we can monitor, in this way we can prevent systemic risk, but also within micro-prudential supervision, the possible failure of the single entity. So MiFID is quite complex, because every time they might issue a new amendment of MiFID, and then every time, this is a good job for lawyers in Europe, your client will come to you to say what are the new obligations under MiFID. And there are all a list of requirements that all intermediaries, financial institutions, they need to abide. Otherwise, if you are not MiFID compliant, you cannot operate, you can even lose your license, your authorization. So that is something that now is still under discussion. They would like to simplify all those imposing of requirements, because the more requirements you have from a practical point of view as an investment bank or as in reality a financial institution, the more money you need to spend in compliance. So smaller firms, they don't have ability. Bigger firms, yes. So they say, in fact, what they say in Europe today is that we should go towards proportionality. We should see this simplification of rules should be directed as a guiding principle through proportionality. So we need to be proportionate. If you are a small firm, you should not have the same requirements imposed to bigger, because otherwise you run out of money, or you don't even have the possibility to comply with the high level of imposing requirements that MiFID is giving to you. And it is just a slide not to know, but to show you how long is the process, or even how many consultations in reality ESMA is conducted in order, for example, to reform this kind of sectors that relate to equity, and so the issuance of securities through prospectus requirements, prospectus regulation, even that now was under reform during these years. Derivatives were under reform in the reporting requirements, and so on. So the job of ESMA was massive, but it's also true that all this kind of consultation, soft law, questionnaires, and so on, is creating a very complex system of the law that is no more intelligible. So they need to try to simplify this process. This process is too complex. Why this is done, we said, is because there is no centralization. Probably if there was centralization, ESMA, like the Securities and Exchange Commission, could issue a new rule, would have been applicable to all the states, would have been simpler. But this is not possible. So this is a sort of always of compromise to avoid political friction, essentially. So that is why it is done. But as you can see, it's quite complex. But this kind of process then brought us to the Listing Act. So this is the new other big reform in Europe that they tried in reality to even deregulate some requirements of the prospectus regulation in order to facilitate the listing of issuers. Until today, Amsterdam is going very well. So in reality, Amsterdam is little by little replacing the role of London. And this is also another point of the Capital Markets Union, that is to expand the political role of Europe. So in reality, this political role also passes through this kind of idea that if you have more, you are more competitive from listing venues, you have more prestige. Now, in the past was more difficult to compete with London, but London still was part of the European Union. Now that they are no more part of the European Union, there is a big competition that is also in historical roots between Amsterdam and London. And London is losing, in reality, the ground. It's losing the ground, and many companies, venture capitalists or whatever, they are listing in Amsterdam or US, but in US especially. In fact, it will be very interesting then at the end of this course, because we speak about SPACs, and today if you read the lines, for example, SPACs, they have almost 2/3 of the entire volume of IPO market in the US. So like the past of 2020, we came back to today with the same level of trade in the US. So in reality, that is quite interesting, because also can show that usually, and this is something you find in the slide, we are going towards an idea of private markets. Before there was this idea of public offering, this idea that public markets is where you list equity through a certain procedure that is public, governed by certain rules, and not designed by market operators. But now SPACs that again are having a big moment in the US can show that maybe traditional IPO can be replaced by alternative ways that are promoted by the market. So private markets today, they count even more than public markets in the old conception of public markets, classic conception of public markets. And it is something that you find then at the end of the slides. Investor protection, we said many times, is the key of MiFID, and so not only in the UK but also in Europe. This is something we said in the past, different approach between US, UK, Europe. Europe, UK, very similar, investor protection. This investor protection that is based on rules, many times also on company law. So here there is even an interface between company law and regulatory practices. Disclosure requirements, the prospectus regulation we said many times. This is quite interesting, the market abuse regulation. So in reality, in Europe now we have this regulation, and this regulation is giving you a definition of insider dealing, and this definition is here, defines inside information. So in reality it's not giving insider dealing definition, but what is inside information, as an information of a precise nature, not made public, relating directly or indirectly to an issuer of or financial instrument, which would likely have significant effect on prices if made public. So it means that there is a person that is taking, let's say, advantage of the market because they have an inside news. With this inside news, maybe they buy shares, the shares appreciate in value, and they make a profit that is quite consistent. Today, this thing is illegal, it's against the law. But in the past, and that is interesting in financial history, was not something illegal. So in reality, this insider trading, what we define today as insider trading, was not illegal. Was something that was consented by the market and also was a commercial practice, where if a person is more aware of a phenomenon and takes advantage of that and is making money, this is how business is conducted. That was the idea. This idea you can find also in my book, that is The Speculator of Financial Markets, and relates to the Battle of Waterloo with Napoleon. That is the final battle in Europe, where in reality then the English they won with the French, where English and Russia, Prussia, yes. Yeah, there were two different armies, but the main one was English. Against Napoleon they won. So at the time what happened? Gilts are the equivalent of UK sovereign bonds. So Nathan Rothschild speculated on those bonds. So at the moment of the war, the bonds in the UK, they were trading very low. So Nathan Rothschild, because he knew that essentially the Battle of Waterloo was already won by the British army, but at the time there was not TV. So in reality he could know this news, this inside information. He bought a lot of bonds, and then these gilts appreciated massively in value because the British they won. And they say that the Rothschild as a family, all this big fortune is because of him, that did this insider dealing. And so this is also why then historically Nazism used this history, this story, to go against Jewish, saying that they were the devil, because essentially they could use and manipulate market information in order for their own profit. And they don't care about maybe nations, they don't care about the moment, they just care about money. That was the speculation, was made by this news. Then in reality this account is even fake, was manipulated by Hitler and so on, because at the time this was not a crime, was not within the law, was within commercial practices, and in reality Nathan Rothschild paid privately, in reality Courier, to know this news. So as he paid, you could pay, but many people that didn't think of it. So markets were less regulated. This regulation then came first of all in Wall Street, so 1929. So this kind of financial history you can keep in your mind, because then Douglas will speak to you about market abuse, but maybe he will not mention this history. So now you have the ground. The ground is from here. So then in 1929, in 1919, with the crash of Wall Street and so on, in 1929 we have this new legislation with the Security and Exchange Act 1934, and there we have a criminalization of insider dealing. But before there was not a crime even there. And then you have the UK. The UK also did some steps, but in reality very recent time. So in reality it took a long time actually. And this moment is the Companies Act, 1980. So this is something that I think I already told you, that everything in securities laws in the UK is based on self-regulation as a second pillar of securities laws. So the first pillar is the statutory law, the example of the US. The second pillar is self-regulation. Because of self-regulation and reputation, many people, they thought that no one was doing this kind of fraud on the market. But then in reality self-regulation is not enforceable. And so for this reason the system was created in a way that also the UK started to impose some specific rules in order to criminalize insider dealing. For example, for your dissertations, I don't know if you already decided or if you have room to insert this, But if you write about insider dealing, it's very innovative because very few people they made research on insider dealing. So in reality, this is something very interesting that we don't know why, but very few people they did some research on it. While in reality is very important today, because then this thing of insider dealing is in everything. Even I don't know if there is some scandal about cryptocurrencies, is about insider dealing. Even if there is the war and maybe there is JP Morgan that is making money by selling bonds that were financing the war, all these kind of things is insider dealing. So insider dealing is interesting, but it's very difficult also to be defined in law. So this is the reason why maybe it's more challenging if you take research on it, because you don't have a lot of resources. You have generic sources, but you don't have something that really trace the history or really trace the legislative modification and also how insider dealing definition then change in time. EMIR we already said, so in reality EMIR is this regulation about derivatives, introducing central clearing counterparties as a new intermediary between the parties of the financial derivatives contract. And here is the final picture, through which I think we can close today. So essentially, you cannot understand European securities laws by looking in isolation those instruments, but all together they form a set of rules. We said we don't have a unified code, but we have this set of rules through which we can design a code of securities laws within the European Union. So MiFID is for market structure, financial products, trading venues, the market abuse regulation to protect integrity, the prospectus regulation that governs primary issuance like the Securities Act 1933 in the US, and EMIR for derivatives. So it is fragmented a bit. It's not in a single package of reform like in the US. This is also why, because this fragmentation reflects the political compromise of Europe that is not towards centralization. So ESMA is not one single regulator. There are still all the national competition authorities. So for today we cover it. Then at the end of the slide you find, I mean, here especially these contemporary challenges. This I gave to you for the say. So in reality, rather than thinking a lot and so on, you have already a summary here, because this kind of challenges you might use in some essay. So rather than starting your research from nothing, you already have this, you have already some ideas, and you can work on those ideas, so that you already know how to draft then the essay. Any question? Yeah.
On simplification, but more specifically,
Yeah.
today in the European Union, what are the areas of intervention that needs more simplification? Because the first one I'm thinking capital requirements, but the European Union already moved in this direction, for example, preferring the standardized approach than the IOB approach for risk assessment.
Yes, essentially, I mean, in this moment they are in discussion on what to do, because essentially, for example, they adopted the crypto asset regulation, MiCAR, but that is already adopted, but that already should need a simplification. So first of all, they are just speaking today what simplification means, and now we are already in a good point to understand. The Listing Act, speaking about securities regulation, it is an example of simplification. So that they already did for securities laws, because they did the Listing Act. But some people now they're making a critique that the Listing Act is not simplified, is deregulated. So that is the main point. The difficult point is the balance and the border. Where is simplification? Where is deregulation? Deregulation is quite simple because it's just scrapping the rules. But simplification is not simple because there is not a real definition. And so we might say many principles, we might be follow many principles, but then in reality, I mean, in practice can mean many different things. In some areas more than others. In securities law, with the Listing Act, they might even take off maybe some disclosure requirements, but that is more deregulation, while maybe simplification should be more to simplify the obligation of disclosure. Some continuous disclosures once you are listed on the market, maybe they can be delayed, or maybe rather than being 3 times per year, can be 1. This is a simplification. Deregulation is discretionary, and that is why at the end of the day it's more political, and they will never achieve what they want to achieve, in my view. That is what I think for real. Yes, it's more difficult, it's very difficult because there are 27 member states, and so if you start to be more proactive, others they don't like. If you are not active, others they don't like. They try to take a middle position. In fact, they speak about simplification equal proportionality. Proportionality, from a practical point of view, is good. You can simplify through proportionality. You impose more requirements for bigger banks, less requirements for smaller banks. You might be able also in a proportional manner to make available resolution regimes, not only for big banks, but also for smaller banks. So that is something that can simplify, so that resolution regimes are applicable for everyone. So that is more unification, harmonization. But still, is something that it depends on the political agreement also that is in the European Union. So Europe is even slower because there is not centralization. There is not a centralization of power. But this is because of Nazism, in the sense that at that point, at the time, they thought that all the power that is concentrated in one hand can generate that regime. And so